Hello and welcome back. In this video, we will continue the discussion on adjusting entries in accounting. As you know, adjusting entries are when companies use the accrual basis to prepare their financial statements, and there are some revenues or expenses that need to be recognized on the last day of the accounting period. So the next logical thing to speak on would be depreciation. Now, what is depreciation? Well, companies often will buy assets that they'll use for multiple years. These can be referred to as long-term or non-current assets. And the cost associated with using these long-term assets is going to be called depreciation expense. Now, as you know, assets will not last forever. And so a company must recognize the net economic benefit of running their business. So they have to estimate how much of the long-term asset is actually used in the process of earning revenue each year. A quick note is that the land asset account will never be depreciated. You cannot depreciate land because it's expected to be used for eternity. So to calculate depreciation expense, which will show up on the income statement, you will need the following four items. First, you need the cost or the amount paid to purchase the long-term asset. Next, you need the useful life, which is the time period that the company expects to use the asset. This is going to be an estimated amount, and it can change. You'll also need the salvage value or residual value, and this is the amount that the company expects to receive from the sale of the asset at the end of its useful life. And this is also an estimated amount, and it could also change. And then lastly, you'll need the date of purchase, because these long-term assets are only depreciated for the months that the asset is owned by the company. So to calculate depreciation expense, we'll cost, which is the amount paid for the asset, minus the salvage value. Again, that's the amount the company thinks that they can get at the end of its useful life if they sell the asset. We're going to divide that by the useful life of the asset, which is how long the company thinks that they can use the asset. And this specific calculation is going to be referred to as the straight line method of calculating depreciation. There are other methods of calculating depreciation, but we will only talk about the straight line method in this chapter. We'll get to other methods in the future. Now, when we report these long-term assets, we report them on our balance sheet at the book value. And the book value is calculated based on the cost or the price paid for the asset, less something called accumulated depreciation. Now, accumulated depreciation is a balance sheet account which captures the depreciation expense over time, and it lowers the cost of the asset to get to what's determined to be the book value. So just a note here, the cost of the asset will not be decreased by depreciation. The depreciation amount will be kept track of in the accumulated depreciation account. So for an example of calculating depreciation expense, we have Jackson Company with the following events during its first year of operations. On January 2, year 1, Jackson Company paid $37,000 cash to purchase equipment. The company estimated that the equipment had a salvage value of $2,000 and an estimated useful life of 7 years. At the end of year 1, Jackson Company recognized the expense of using the equipment in year 1. And what that's saying is Jackson Company recognized the depreciation expense of the equipment. And then the question would like us to use the horizontal financial statements model to show how each of these events affect the balance sheet, income statement, and statement of cash flows. So the first thing I want to go through is calculating the depreciation expense, and then how the depreciation expense income statement account and the accumulated depreciation balance sheet account flow and affect one another. So the first thing I'd like to do is calculate the depreciation expense using the straight line method. Again, that is cost of the asset to what was paid for the asset, $37,000, minus the salvage value. In this case, the company thinks that they can get $2,000 if they sell it at the end of the useful life. And we're going to divide that by the useful life, which is 7 years. So that gets us to a depreciation expense of $5,000 per year. So what that means is if I go down here, I have year 1 through year 7 on a line. And my first thing that I want to put down is my depreciation expense. So as we just said, the depreciation expense is $5,000 each year. So after 7 years, I will have depreciated $35,000 cost. And that is correct because if we take the cost paid of $37,000 minus the salvage value, we have a depreciable base of $35,000. Next, I want to look at how the depreciation expense affects the accumulated depreciation account on the balance sheet. So, the accumulated depreciation balance sheet account is the cumulative total of depreciation expense over time. So, at the beginning of year 1, which is January 1, year 1, before the company bought the asset, before there any depreciation expense was recorded, the beginning balance of that accumulated depreciation account was 0. Now we have depreciation expense to add for year 1, which was calculated above. We said it was $5,000. So if we take our beginning balance plus the depreciation expense, we get the ending accumulated depreciation of $5,000. Now moving on to how the accumulated depreciation affects the book value of the asset. Well, we know that the cost is $37,000. That's the amount that the company paid. And then we need to remove from the cost any accumulated depreciation to get to the book value. So at the end of year 1, we have $5,000 of accumulated depreciation. So therefore, at the end of year 1, the book value of this equipment was $32,000. So if we carry that forward, we're starting depreciation expense of year 2 still at $5,000 under the straight line method. Depreciation expense is the same each year. My beginning accumulated depreciation balance is now what I ended the previous year with, so $5,000. I'm adding to that my $5,000 of depreciation expense. That gives me $10,000 of accumulated depreciation for year 2. Now, what is my cost in year 2 of the equipment? The cost is still $37,000. We do not change the amount that the asset is recorded in the books. The way that we show the value declining is by showing accumulated depreciation in the book value of the asset. So then we subtract our accumulated depreciation for year 2 and we get a book value of $27,000. So moving on, beginning accumulated depreciation for year 3 is $10,000 because that's what we ended year 2 with. And then our depreciation expense for year 3 is $5,000. So now we have $15,000 of accumulated depreciation at the end of year 3. Our cost of the asset is still the same. Our accumulated depreciation is now $15,000, so our book value in year 3 is $22,000. In year 4, depreciation expense is still $5,000, but now our beginning accumulated depreciation is $15,000. So that gives us $20,000 of accumulated depreciation. Cost has not changed. So $37,000. We take away the accumulated depreciation for year 4, so we have $17,000 of book value. Starting year 5, we have $20,000 of accumulated depreciation beginning balance. We add to that depreciation expense of $5,000. Gives us $25,000 of ending accumulated depreciation for the year. The cost is still $37,000, and we have $25,000 of accumulated depreciation. So now we're down to $12,000 of book value. All right, starting year 6, we have $25,000 of accumulated depreciation. Then we add to that our depreciation expense, so $30,000 in the accumulated depreciation. Cost was still $37,000. Take away the accumulated depreciation at the end of year 6, which is $30,000, leaves a book value of $7,000. Now, the final year, year 7, we're starting with accumulated depreciation of $30,000. We have $5,000 of depreciation expense, which gives us $35,000 of accumulated depreciation at the end of the year, which, as we said a second ago, that is our depreciable base. That is all we can depreciate of this asset. So now if we come down, So now if we come down to the cost for year 7, it's still $37,000, but now we've depreciated this asset fully. And we get down to our salvage value of $2,000 as our book value. Now, if for any reason the company did not sell this asset in year 7, they kept it on their books for another year, so now we're in year 8, there would be no depreciation expense calculated because you cannot depreciate an asset below the salvage value. So this asset will stay on the books at a book value of $2,000 until it is sold or disposed of. All right, so now we know how the depreciation expense and accumulated depreciation items at book value. So let's move into showing how the two transactions we just discussed show up on the horizontal financial statement model. So in the first one, again, we have Jackson Company paying $37,000 cash to purchase equipment. Cash is an asset account, and we have $37,000 of cash going out. The cash was paid out to purchase equipment, which is also an asset account. And because we're purchasing equipment, the $37,000 is a positive. So we have a negative 37 and a positive 37 both on the asset side of the accounting equation. So we're net zero on both sides. So we are a balanced accounting equation number 1 from the balance sheet. So let's move to the income statement. Income statement. Were there any revenues or expenses mentioned in number 1? The company paid $37,000 to purchase equipment. There was a salvage value and a useful life determined. No revenues, no expenses. However, if we move to the statement of cash flows, there was $37,000 of cash that went out to purchase a long-term asset, this equipment, so therefore this was an investing activity. Now if we move to number 2, the company recognizes the expense of using the equipment in year 1. So there is $5,000 of depreciation expense, which we must show. So first we have to show it on the balance sheet. We know that expenses affect which account on the balance sheet? Expenses affect retained earnings negatively. So there is a negative $5,000 of retained earnings going out. And then similarly, because we are showing this depreciation expense, we drop the value of the book value of the equipment by the same amount, which is $5,000. Right? We have a balanced balance sheet accounting equation. Let's move to the income statement. So were there any revenues? There was not, but there was $5,000 of depreciation expense. And we know that expenses have a negative impact on the income statement or on net income. And then lastly, on the statement of cash flows, there was no cash exchanged here. Depreciation expense is going to be a year-end adjusting entry. So there is no cash moving, and therefore, because it is an adjusting entry, it will never show up on the statement of cash flows in this particular way.